and welcome to our special pre-budget series, Ideas for India. This budget will probably rest on four major pillars. 1, its fiscal balance. 2, its approach to banks. 3, its infrastructure push. And 4, its effort to relieve rural distress. Today we discuss the king of all budget themes, the fiscal balance. The key question we are asking today is, should the budget stick to a fiscal deficit of 3.5% of GDP? Those in favour have argued that 3.5% ought to have been reached this year, FY16 itself. We are already late by 1 year if we reach it next year. This year, the states too will borrow more money. And finally, we may not get the advantage of low crude oil prices next year that we have got this year. Hence, must meet 3.5 this year. Those who want fiscal largesse point out to the anemic growth in India and the world, the fact that world over governments are being goaded to spend, and that fiscal excess wisely invested is better than a number-driven stinginess. Well, there is much at stake on both sides, so we have a star panel for you. Rakesh Mohan, Eminent Economist, former Reserve Bank of India Deputy Governor; Jahangir, Aziz, Chief Economist, JP Morgan; and Sonal, Varma, Chief Economist, Nomura. Gentlemen and lady, welcome to the show. Let me start with you, Dr. Mohan, as a person who, when you wore your IMF hat, saw a lot of other economies grappling with similar problems. How sacred should that 3.5% target be?
I'll speak somewhat with a forked tongue, in the sense that I think it is indeed important for the government to provide credibility to its fiscal programs, so that once they set targets, it's important that the world at large understands that our government means business in terms of keeping to targets and keeping fiscal prudence as among the top objectives of fiscal policy. Having said that, I would, however, say that it is important to give a greater focus on the quality of expenditure and the composition of expenditure. It does seem to me that at the current time, when private investment in India is indeed lagging, given the stressed balance sheets of many of the large segments of the corporate sector and the corresponding stressed balance sheets of banks, the likelihood of private investment reviving in the coming fiscal year does not seem to be very high.
Yes.
And therefore it's very important for the government to really step up public investment in a credible and transparent fashion. So it is in that context that what I would say is that it's important that the government provide a clear program of public investment in roads, in the railways, in health, in urban infrastructure and so on, in ports and so on, both public and private, but particularly the public investment. But the important point here is that they need to do this in a transparent fashion, to say that, look, last year we spent so much in public investment, this year we're going to spend so much in public investment, and provide evidence of a big push, and also, of course, set up the implementation procedures. Okay. If they're able to do that, then corresponding with that, one needs to look at the revenue sources for such increases in public investment. And that could indeed be either through the IIFCL as off-budget borrowing, or I would even say that one could suggest that there should be special infrastructure bonds floated by the government, whose proceeds go into a public account, which is non-lapsable, and whose proceeds are only used for public investment. They would be no different from any other bonds, but they should be labeled as infrastructure bonds, whose proceeds get separated from the rest of the budget.
Fair point. Okay, so that's a couple of ideas. One, that the deficit can be reneged on, provided it is for investment purposes, and then some off-balance sheet money raising. But Dr. Mohan, just one more very brief question before I go to the others. What is forgivable in the form of fiscal largesse? Not 3.5. Would you be okay with 3.6, 3.7, 3.8, 3.9?
I don't really want to focus on a particular number. As I said, what is more important are the actual public investment figures and credibility in being able to make their investment in public in the infrastructure sector.
Now, I still want to tie you down, sir. 3.9 or 3.7, there is a wide difference. If it is 3.9 or 4, you have not adjusted at all. If it is 3.7, you have shown
you're not going to succeed. You're not going to succeed in tying me down, since I'm an independent person now. So let me just add one more point, actually. That we do have a tax GDP ratio that is low by any standards, that is lower than comparable economies with similar per capita incomes. And so we also need to focus much more on revenue raising in order to increase public investment.
Jahangir, what would your number be? And I really want a number. I think credibility is very different if it is 3.5 and if it is 3.9. What kind of a fiscal deficit should the government come out with?
3.5.
Okay. And your argument would be?
Because anything else is incredulous. You can't, last year, as you pointed out, the government said, well, this year we are in a pretty bad shape. We need to support the economy, so let's not go the full distance of fiscal consolidation. But next year we will do it. Here comes next year, we're going to say, well, not really, the world is still pretty weak. I'm going to do it next year. The question that it raises is that if at $30 a barrel, that this government cannot consolidate half a percentage point of GDP, when can it?
Okay.
And it isn't that the government did not have the revenue. It had half a percentage point of windfall gain from lower than expected oil, this thing, which they completely taxed it away. So the fiscal management was not that they didn't have revenue. It's just that they had revenue. They simply did not want to use the other revenue shortfall. I mean, privatization, for example, wasn't completed. So the fiscal management this year was pretty baffling. Because if they had actually passed on that half a percentage point of excise taxes to consumers, even RBI would say that by their own estimates, the average inflation rate would be at least about 100 basis points lower. By the RBI's own logic, the RBI would be cutting repo rates by another 100 basis points. So here we are, stuck in a world in which we did not really get any growth advantage. We have higher inflation, we have higher interest rates, and even the stock market wasn't buffered by the very, very inexplicable fiscal management of last year. So I know Dr. Mohan is talking about credibility, but there is no real credibility if they keep on doing the same things as they did last year without changing the framework.
All right. I'll come back to the off-balance sheet ideas that Dr. Mohan has thrown in a minute. But let me get Sonal in on which side of the debate she is. Dr. Mohan won't mind something higher than 3.5, which I think to be substantial should be closer to 3.9. Jahangir is at 3.5. What's your advice, Sonal?
Yeah, I think, one needs to do a cost-benefit analysis of, slipping versus not slipping. And the question is the reason why we are slipping. Clearly it's important to consolidate and we also need public investment in infrastructure. But actually the FRBM came into effect in 2003 and we are still struggling to get to 3% of GDP. And the reason why we are debating a slip this year is not because of CAPEX, but it's actually because of the pay commission, which is going to add almost 0.7% of GDP, pay commission and the one rank, one pension. So the quality of spending that's really going to happen on the balance sheet in FY17 is not going to be so much pro-capital expenditure as, we are making it out to be here. And second is the fact that we've been focusing so much on the central fiscal deficit, but state deficits are also expected to actually expand in the next couple of years because of their own implementation of the pay commission and the Uday interest payments that they have to make. And therefore the aggregate borrowing even by the state government is actually growing quite rapidly. And therefore the total borrowing by the general government is actually quite large and large relative to the total demand that we are seeing. So what we do not want is the benefit that we think we will get out of these stimulus actually ends up being completely offset by the costs that we impose on the economy because of, again, giving out a consumption-led stimulus, partly crowding out other investments which in any case are suffering. So at this stage, I think there's no debate that India needs more public investment in infrastructure. But if it is off balance sheet, yes. If it can be financed through new revenue sources, yes, why not? But if it's going to come at the cost of slipping on the fiscal front, at this stage, I think the costs are probably more than the benefits.
Okay. Dr. Mohan, at the moment you're 1 versus 2 people preferring fiscal discipline. They would prefer off-balance sheet and more revenues, newer tax revenues. We will debate both that in a minute with our guests. Have to take a mandatory break.